Ever heard of Monster Energy? Of course you have. But here's the crazy part. Back in the early 2000s, almost nobody did. Monster was a tiny, unknown company, and its stock was trading for literal pennies. Fast forward to today, and Monster Energy has become one of the most famous penny stock success stories of all time. That's exactly why, even in 2026, penny stocks still grab investors' attention. The idea that a small, overlooked company could turn a few $100s into life-changing money is powerful. But just like a real penny, there are always two sides to the story. This video is not about telling you to go all in on penny stocks or promising you'll become the next millionaire. Instead, this is about understanding penny stocks, what they are, how they work in today's 2026 market, where people find them, what's changed recently, and most importantly, the risks involved. Once you understand all of that, you can decide for yourself whether penny stocks deserve a place in your portfolio or not. So let's start with the basics. In the US, penny stocks are generally defined as stocks trading under $5 per share. Some investors stretch that definition to under $10, while purists say a true penny stock should trade for actual cents. In 2026, most penny stocks are still found outside the major exchanges. While a few trade on NASDAQ or the NYSE, the majority trade on the over-the-counter market, where reporting requirements are lighter and oversight is weaker. That doesn't automatically mean they're bad companies. Some are real businesses with real products and real revenue. Others, unfortunately, exist mostly on hype. One major 2026 update is that regulators are paying much closer attention to microcap and penny stocks than they did in the past. After years of social media-driven pump-and-dump schemes, the SEC and FINRA have increased enforcement actions. Several high-profile cases in 2025 and early 2026 involved influencers and promoters who were fined or banned for secretly being paid to hype penny stocks. This means investors today should be more skeptical than ever of viral stock tips, Discord groups, and guaranteed winners on social media. So why do people still invest in penny stocks despite all of this? The answer hasn't really changed. First, there's the long-term speculative investor, the person hoping to find the next Monster Energy, the next early-stage company that grows into a real brand over the next decade. Second, there are short-term traders who are attracted to volatility. In 2026, penny stocks can still move 30%, 50%, or even 100% in a single day based on news, rumors, or trading volume alone. For experienced traders, those swings can mean opportunity. For beginners, they can mean fast losses. When it comes to evaluating penny stocks, approach matters. Traders often focus on volume and liquidity. If a stock barely trades, you might buy in and find yourself stuck with no buyers when you want out. High volume doesn't make a stock safe, but it does make it easier to enter and exit positions. Long-term investors, on the other hand, should focus on the business itself. In 2026, one of the biggest challenges with penny stocks is still transparency. Financial statements can be limited, outdated, or self-reported. Press releases often highlight best-case scenarios while ignoring risks. That means you have to dig deeper than the headline price. Another important 2026 trend is the tightening of exchange rules. NASDAQ has continued delisting companies that fail to maintain minimum price levels or reporting standards. That's a reminder that just because a stock is listed on a major exchange doesn't mean it's low risk. Delistings can crush a stock overnight, leaving investors with steep losses and limited liquidity. Now let's talk about risk, because this is where penny stocks truly separate themselves from traditional investments. Penny stocks are extremely volatile. They can lose half their value in days or even hours. Liquidity can dry up fast. Scams still exist even with increased regulation. And many of these companies are early-stage businesses that may never become profitable. Even the ones with promising ideas can fail due to poor management, lack of funding, or changing market conditions. That's why most financial professionals in 2026 still recommend limiting penny stocks to a small portion of your portfolio, often around 5 to 10% at most. These are not investments where you bet the farm. You should never invest money you can't afford to lose. Even the best-looking penny stock can go to zero. So what's the bottom line? Penny stocks remain one of the most exciting and dangerous corners of the stock market. Stories like Monster Energy keep the dream alive, but they are the exception, not the rule. In today's market, success with penny stocks requires skepticism, research discipline, and realistic expectations. If you understand the risks, Control your position size and avoid hype. Penny stocks can sometimes play a role in a broader strategy, but if you chase quick riches without understanding what you're buying, they can just as easily wipe you out. At the end of the day, penny stocks aren't about getting rich overnight. They're about risk, patience, and education. Know what you're getting into, protect your capital, and make decisions based on facts, not excitement. That's how smart investors approach penny stocks in 2026.